In September 2008, Lehman Brothers, which was the fourth largest bank on Wall Street, went bankrupt. And in the aftermath of that happening, many other financial institutions, including AIG, which was the biggest insurance company in the world, ended up in trouble. Now, in order to come out of the recession, the central banks of the Western world, led by the Federal Reserve of the United States, started to print money. The Federal Reserve printed close to $3.6 trillion. Now, all this money has been floating around in the global economy since then. After the Federal Reserve of the United States, the Bank of England printed money, the European Central Bank printed money, the Bank of Japan printed money. Now, the reason they did that was to drive down interest rates. The idea was that a central bank would print money and pump that money into the financial system, and with a lot more money going around, interest rates would come down. At lower interest rates, people would borrow and spend, companies would borrow and expand, and the economy would recover. Now, the tragedy is that all this did not happen to the extent it was expected to. What happened was that big financial institutions borrowed cheap money, borrowed easy money at very low interest rates and invested it in stock markets and real estate markets all over the world. And these markets ended up rallying much beyond they should have. What also happened was that with so much easy money going around, people obviously started buying gold. And gold always acts as an antithesis to easy money. So which basically means that when central banks of the world, egged by their governments, print money, people end up buying gold. What is happening now is that the Western economies are going back into a recession. At least that is the expectation. In several parts of Europe, the interest rates are now in negative territory, which basically means that if you were to park your money in a bank, the bank, instead of paying you an interest, would charge you an interest for it. And the reason for it is very, very simple. There is just way too much money floating around in the global financial system, and the banks don't want that money. Now, with so much money floating around, there is always a risk of inflation, because this money can be used to buy goods and services, and given that there is only so much goods and services going around, this can ultimately lead to inflation. In this scenario, it makes sense to have some amount of your investment portfolio, depending on your risk profile, preferably 10 to 15% invested in gold. Over a period of time, the price of gold is appreciative in nature, and the rate of return usually tends to be more than the rate of inflation.